What's going on? Let me get this on the. Yo, sorry guys, I was doing the Twitter update. What's going on? Oh, yes. Let's go. Great numbers. Live. Guide for 2023. I think they're just maybe covering themselves up, just to make sure they can beat all their numbers. So maybe the numbers were a little light, but still pretty good growth. So, um, what I saw was the EPS was really good. I mean, the analysts wanted -9 cents, and they came in at -5 cents. So that was huge. That was insane. I think the last quarter the jump was 3 cents. Like they did a Q2 to Q3, they got 3 cents better, and now Q3 to Q4, they got 4 cents better. Or wait, yeah, 4 cents better. So they just keep getting better on their EPS, and that's awesome. If they keep this up, let's say they do the same, another 4 cent jump, they're at a 1 cent loss, and SoFi could be profitable Q2 as a possibility. $143 million in EBITDA for the full year. Um, that was really good as well. The growth was insane. We're talking what 60% growth for the full year, I believe. I mean, this thing is it's growing really fast, and also no student loans. And you're talking, profitability could be 1 quarter away. It's huge, guys. It is very, very good. What this earnings was 480,000 members. Um, that was pretty good as well. I know a lot of people wanted like 500, but still very, very impressive. Let's see the earnings webcast. Let's see, we'll be at 8 o'clock. Okay, I got on here early for once. Finally. There we go. Oh wow, wait. Okay. It opens up at 11 minutes. Okay, cool. Let's get all these pop-ups out of the way. All right, let's go, baby. Let's go. Let's go. I honestly haven't even looked at the stock in about 20 minutes. So what's the stock even doing? I haven't even looked. Let's see. Uh, what we 9%. It should be up. It should be up more than that, but maybe things will change. A lot of people have been talking about this earnings. It may change the price reaction you see on SoFi because you don't have SoftBank uh, dumping every single earnings. Some people were saying they were dumping, a couple 100 million shares every earnings for a full year because, they made some bad investment decisions and they're just trying to save $1 billion everywhere they could. So maybe with SoftBank not selling out everything like they did, maybe that'll give the stock a different reaction. Okay, so that's something to look forward to. SoftBank finally completely out of this stock right now. I mean, they're gone. They owned at one point they owned like 15 to 20% of SoFi. So that could be a difference in the price reaction you get the following days from SoFi. You may not get those sell-offs, anymore. You might get a little bit of a better hold. So, yep, some people are saying we could be profitable next quarter, and that will be an amazing feeling. I mean, imagine holding a stock growing uh 30 to 50% for the next couple of years, profitable. I mean, you could be looking at things like buybacks, you could be looking at dividends, you could be looking at, a lot of different stuff. Okay. I mean, this could be a very good stock that can actually, you know, pretty much, do what a lot of the other cult like stocks did. You got Tesla taking on the gasoline, um, Netflix beating out retail, and the same thing could possibly happen again with these brick and mortar banks. You got a lot of cost savings is happening right now. I mean, look at this. SoFi turns on the cost savings. Look what you just saw. You just saw EPS 9 cents to 5 cents. If they want to turn it on, they can turn it on. So I need to go into these earnings and look a little bit more. I think the earnings call is at 8 o'clock. So yeah, I know I got Q3 in the description. I know I wasn't paying attention. I did it really quickly. I'll probably fix that. Let's see if I can fix that real quick. Um, yeah, thank you for saying that. I just was moving so dang quick this morning trying to get the video up. Let's see. Yeah, I could fix that really quick. Q4, there we go. Yeah, that's fixed now. Q4, Q4, Q4. Yeah, that's fixed. Okay. Thank you for that. Appreciate it. All right. So we got that updated so people don't get confused. Honestly, the stock may finish up. I don't know what's going on. They said the market today is absolutely tanking. I saw Alibaba was massively down. That's probably just because we had all those gains last week. So you may not see some of those bigger rips that we saw the last 2 quarters, with 30% plus. So maybe up 15% to end the day, which would be still very, very well. This market's weird, guys. I mean, I know we've had a little rally. I think the Nasdaq rallied like 12%, which is good, but you got to think it was still down 35% at one point. So, there's still 20% losses left in the Nasdaq. I think for the market to actually stabilize, enter a bull market, Jerome Powell needs to make up his mind what he actually wants to accomplish. Is he worried about inflation coming down? Does he care about a recession, mild recession? It's all up to him. He pretty much controls everything. I think we've come to realize that. I'm not gonna lie, I've been, trying to do some financial stuff. I've been trying to buy another truck, vehicle. Interest rates for like a new vehicle right now are like 5 to 6%. I financed my last car, BMW. I financed it at 2% a couple years ago. So that's a big loss you're taking. A 2% finance to a 6% finance on a vehicle. Absolutely insane. Mortgages used to be 2%. Those are up to 5 to 7%. And it's all because of Jerome Powell. He's made this happen in a matter of 6 months. He is really, you know, you're not getting any value, when you go to buy stuff, you're getting just hammered by interest, and that's what he wants. But how long is he going to do it for? Um, that's going to move the stock market as well. So I think he talks like tomorrow or something. But guys, I mean, that's really what's been holding the stock market back. So come on, guys, let's get a little bit. We got to get a little bit of likes on this. We only got 27 likes. Smash the like button if you could find it. Likes are way too low. Man, we got to get some likes. 27. Holy crap! We used to get 1,000 likes every YouTube video when the market was doing decent. Those were good times. 1,000 likes a video. I understand we've been in a bear market. What is it? 12 to 14 months. It sucks. It sucks. But guess what? You don't want to sell at the bottom. You want to sell high, 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 high. Even though it hurts when we were holding the stock at $4, $5, it sucked. But you got to remember, guys, the stock was at book value. There's no growth priced in at all. Nothing. So there was a lot of value in the stock market everywhere, all the fintechs, Block, Tesla, Affirm, there was value. These stocks were trading at a third of their, freaking IPO prices. So there's value everywhere. It's just what fintech is going to be profitable and continue to grow. Okay, even though Lending Club is profitable, it's a good example. Their growth is like just deteriorating, like their growth was 50%, 30, 20. I think they had 10% growth the last quarter. So they're playing it very cautious. And SoFi, I mean, I got to look at these earnings too, guys. I mean, I really didn't look too much at these earnings. I saw that what did I really see? I seen that. Let's take a look, guys. Okay. Here we go. Net revenue full year 1.57 billion. 60% year-over-year growth. That's awesome. Adjusted EBITDA full year. Listen to this, guys. Listen to this. Adjusted EBITDA. I know that's for interest and taxes or whatever, but listen to this. Last year they had 30 million EBITDA. This year, 143 million EBITDA. That's 474% year-over-year growth on EBITDA. That's crazy. Now, full year losses, the entire year. 2021, 483 million. 2022, 320 million. 34% year over year. So losses declined drastically. And possibly next quarter, guys, we could be looking at a 1 or a 2 cent EPS loss, like 10 million bucks, 1 to 2 cents with continuous growth. We're in Q1 right now. So you're talking about profitability could be, 3 months away, Q2. Like you're there. You did it. You're almost there. Just let them, keep doing what they're doing. One more quarter. You're not talking about 3 to 5 more years. You're talking about one more quarter. Like I said, if you watch my YouTube videos the past 2 years on SoFi, they were supposed to be profitable like 9 months ago, but look at the student loans. You got 12 to 14 pauses. You know what I mean? I probably would have been right if the student loans were back when they were supposed to be. This would have been an amazing profitable company. You're talking $100 million plus profitability. It didn't happen. They're making pivots. They're making adjustments. And, I think before you know it, 2024, you could be looking at some buybacks or something, when they're producing great net income. So this was the biggest member growth in 4 quarters, so a whole year, okay? Q4 2021, 523,000. This year, 480. So, or this quarter. So 12 months, second biggest. quarterly growth. Um, New product 695K. Galileo still putting up 7 more million accounts, 31% growth. Pretty good. I mean, guys, the thing that was big about this quarter was just like getting closer to profitability. SoFi really focused in on that. The revenue didn't really explode like I expected. If you guys looked at my estimates, I thought maybe 460 million on net revenue, and it was about 443. But the EBITDA just went from 44 million last quarter to 70 million. That's crazy. That's a good jump. 14x year over year growth for EBITDA. Awesome. Full year 143 million. You really want to see that. Now we'll go to the Q 2023, the guidance. Q1 they're putting out 430 to 440 million revenue. That's like 37% growth on the top end. Adjusted EBITDA 40 to 45 million. Maybe really conservative estimates. Full year they see 30% growth on the high end, 2 billion. Maybe they put out 2.1 to 2.2 billion revenue. So next year could possibly be, maybe 40% growth max. We'll see, because SoFi really, they beat their estimates this year by almost 80 million. So maybe 40% growth max. We'll see how the environment changes. But look at EBITDA for 2023, guys. 260 to 280 million dollars. That's doubled from what you're seeing right now. Just doubled EBITDA again. EBITDA margin 14%. So maybe next year they're focusing more on profitability for the business. Okay, maybe that's what they're focusing in on, but it's not bad. That's not bad at all. Okay. What else did I want to look at? I wanted to look at deposits. Where are deposits? Okay, here we go. Deposits 7.3 billion. That's insane, guys. Massive deposit growth. They were just at what, 5 billion or so, 5.5. So they went up 2 billion in a quarter. Total assets 19 billion. Total liabilities 13.4 billion. So what does that put their that puts them at about the same where they were, a book value 5.5 to 6 billion. So I don't know. All I know is they're trying to get the profitability, guys. Okay, they have assets. Most of these debts they have are like billions in student loan warehouse facilities, it says. So that's a reason why their debt's so high, because they haven't had their student loans in 2 to 3 years. So we're looking pretty good. Let's see. Okay. Lucid is flying. Yep, Lucid's flying, but their numbers aren't as clean as SoFi's. What's going on? 1,000 likes this year. Links going up now. Oh, more than wait, what? SoFi's up? Let's see. Oh wow, they're going down. Jesus, that's a pretty big drop. What the heck was that about? Should be higher than 7, maybe even dividends. What is the EPS number? The EPS number was -5 cents, which came in at negative 40 million, I think. Wow, South Korea, that is awesome. Yeah, earnings didn't suck. Earnings were really, really good, to be honest. They'll be focused on the stock price, so their bonus does not expire worthless. Got to get to 45. Yeah, actually, they don't even have to get to 45 to get the bonuses. They got to get to like 25. So the stock needs to be at $25 by like 2025 or 2026. So 25 is like where all the leadership gets the big bonuses. So is this earning call when it okay. Okay. All right. Everybody, you will get your earnings call loud and clear in 10 minutes. So the earnings call will be loud and clear in 10 minutes. Yeah, guys, I don't think that the earnings are bad right now, that SoFi's dropping. I think it's more of I think the stock market is doing really bad right now. Let's see. Stock market futures or um, S&P, yeah, Nasdaq's down 1.2% right now. The S&P 500 down 1%. So that's pretty bad for the morning. Um, all I know is this quarter is really good. Maybe people are thinking SoFi's 2023 estimates are conservative, but 300 million EBITDA for the next year, that's pretty good. So a lot of companies are collapsing, and this isn't a collapse. This is improving. 100% EBITDA growth, 30% revenue growth. It's not bad. So maybe we could just get by Powell in his speech, and things will get better. Let's see. Yeah, exactly. I think analyst expectations was 9 cents loss. That's a huge beat. It's a great thing. Pulling back right before the earnings call. Take on it, buy more in the year. Yep. Yeah, guys, good earnings. Really good earnings. Best earnings ever so far. I mean, this next earnings call, I mean, we could be talking about a 0 cent loss. I didn't sleep that much. I just kept thinking, I don't know. I woke up, I thought earnings, they were going to release them at 4 and then 6 or something. I didn't know they were going to release them at, what is it, 7? So, man, I don't know, man. We are close to profitability. They're close, man. Oh, let's see. No. The results are out. The results are great. The earnings call is like them talking about the earnings. 8 minutes. No, it's not a hoodie army or army. It's an Adidas. Yep. We'll probably get $3 downgrades from the banks. Yeah, guidance was all right. Looks like they're very conservative, and maybe that is to protect themselves next year so they can beat all their earnings again. So, yeah, guidance, I don't know. 30% growth, it's kind of soft. Maybe they are just being conservative and, just focusing on profitability and not in that crazy growth mode, that they were just in. So, thank you. We will fly. I don't know. I think next year the earnings are that for EBITDA they want 300 million. That's pretty dang good. So 300 million EBITDA, that's awesome. I remember Michael Burry did a tweet about it 6 months ago, and he was calling out thousands of companies. They were like, all these companies are trading for billions of dollars, like in the $2 to $10 billion range, and none of them had even $100 million of EBITDA. We already passed that this year. That was like a standard he was looking for, at least for these growth stocks. He was looking for 100 million EBITDA. And look at that. We're at 148. Now we're going to 300 million. So, SoFi is, they'll probably have a profitable quarter this year easily. It's happening very, very fast. The change in EPS just went from a 3% jump to a 4-cent jump. So we are getting close. Who do I like in the Super Bowl? I like the Bucks. Too bad they're not going to be in it. So I guess the Chiefs. Yeah, guys. Why is the market down so bad right now? Like, what are they talking about? What is going on with the stock market? Asia's richest man loses 28 billion. Adani's market loss swells to 70 billion. What the heck is this, guys? This is number one on CNBC. Is that why the market's down? Founder and chairman Adani's net worth fell 28 billion in the year. What does he own? What's his company? Adani Enterprise. Some guy lost 20 to 30 billion dollars, so that's what the headline is or something right now. Dow futures down 200 points. Fed. Okay, yeah, it's just the Federal Reserve rates decision tomorrow, the rate hike. I guess that's why the market's down. So is Jerome Powell going to do a 25 or a 0 or a 50? That's probably what the market is worried about. Of course, you see what I'm saying? You can't, there's no, the stock market the past year or so, there's so much control. The stocks aren't, able to flow on their own. They're getting babied by Powell every 30 days. And, it's crazy how one man can control everything, It's crazy. So until he, I guess, declines rate hikes, you're going to see these, these crazy, manipulated moves. So 100 per share, 30 per share, 230. I mean, I can't believe, some of these stocks I'm looking at with way larger losses are trading 2 to 3 times larger than us. These other growthy type of stocks. I mean, we're getting like literally the bottom of the barrel book value right now still. I mean, I don't know. I guess you literally have to have, I think you have to have profitability to end all bear nonsense. Like, I think you 100% have to be profitable. Like, your growth doesn't matter. I just think you got to be profitable to just get in the realm of like getting your bear headlines removed. You just got to be profitable. So I think that's what SoFi is tired of. And they're just like, all right, let's do it. Let's just get profitable. Then what are the headlines going to be? Like, literally think about the headline. Oh, card outside. Think about it. If they have a profitable quarter, what are the headlines going to be? SoFi produces profitable quarter. Fintech's likely to not work. Is that what the headline's going to be? SoFi produces profitable quarter. Fintech's luckily not improving. I don't know. Like, you just got to be profitable, guys, at this point. So what do you got? 1 minute. Okay, this is the earnings call right now. 1 minute. Man, I swear, man, they're so close to profitability. It's crazy, man. That was a crazy jump, and 1 or 2 more quarters. That's it. We're there. So close. So close. I think SoFi changed the music. God, man, what is going on with the market, man? Alibaba down 5. That stock is crazy. $801. They missed the. Where is it at? The call. So you said, is the growth over for SoFi? It's not over. You got to think of the type of members that they have in their database. I mean, these are people that are going to grow their wealth for years just through, their jobs. I mean, they could probably grow for 20 to 30% for 10 years plus and continue to grow profitability. So I still think they're gonna grow more than they expect next year. Banks are still growing at 5%. So if SoFi puts up a 40% a year, that's what's that, like 700% larger than the banks. So 5% to 30%, still a big difference.
Good morning, and thank you for attending today's SoFi fourth quarter and full year 2022 earnings conference call. All lines will be placed on mute during the presentation portion of the call, with an opportunity for question and answer at the end. At this time, I would now like to turn the conference over to our host, Maura Sia, SoFi's Investor Relations.
Smash the like button.
Good morning. Welcome to SoFi's fourth quarter and full year 2022 earnings conference call. Joining me today to talk about our results and recent events are Anthony Noto, CEO, and Chris Lapointe, CFO. You can find the presentation accompanying our earnings release on the investor relations section of our website. Our remarks today will include forward-looking statements that are based on our current expectations and forecasts and involve risks and uncertainties. These statements include, but are not limited to, our competitive advantages and strategy, macroeconomic conditions and outlook, future products and services, and future business and financial performance. Our actual results may differ materially from those contemplated by these forward-looking statements. Factors that could cause these results to differ materially are described in today's press release and our upcoming Form 10-K as filed with the Securities and Exchange Commission. Any forward-looking statements that we make on this call are based on assumptions as of today, and we undertake no obligation to update these statements as a result of new information or future events. And now I'd like to turn the call over to Anthony.
Thank you, Maura, and good morning, everyone. 2022 was a remarkable year for SoFi. We accomplished more than any of us could have hoped for. Our resilient team drove great execution of our strategy that is proven to provide the benefits of business diversification and durability to deliver exceptional growth and improving profitability. Our adjusted net revenue grew 52% in 2022 to over $1.5 billion, and we delivered nearly 5 times the adjusted EBITDA we did in 2021. We obtained a national bank license, which could not have come at a better time, allowing us to be incredibly flexible in a rapidly changing environment. We're offering a compelling SoFi Money product that is driving high-quality direct deposit customers, spending, and deposit balances. The deposits bolster and diversify our sources of funding, enabling us to offer our best rates on loans while generating impressive returns and improving net interest income revenue. In fact, 2022 marks the first time our lending net interest income revenue of $530 million by itself exceeded our total directly attributable lending cost of $443 million. We grew our deposits 7 times to $7.3 billion from $1 billion over the course of the year, really powering that cycle. We grew our member base by 1.8 million to 5.2 million members, nearly 9 times our size in 2018. We acquired Technisys, adding a critical capability as we build our end-to-end technology stack and bringing us one step closer to being the AWS of fintech. We navigated unparalleled market volatility, macro headwinds, high inflation, and increasing interest rates, and 2 unexpected extensions of the student loan moratorium by reacting nimbly and leveraging the diversification of our business to hit record revenue in each quarter of the year. The fourth quarter was an incredible end to an exceptional year. We delivered another quarter of record adjusted net revenue and adjusted EBITDA and strong overall operating results. A few key achievements from the quarter include our 7th consecutive quarter of record adjusted net revenue of $443 million, up 58% year over year, which accelerated from 51% year over year growth in the third quarter and reflects record revenue in all 3 business segments. Record adjusted EBITDA of $70 million was up 58% quarter over quarter. That is nearly equal to the total adjusted EBITDA in the first 3 quarters of the year combined. In Q4, we achieved a couple of important financial inflection points. Adjusted EBITDA of $70 million is now largely equal to share-based compensation expense of $71 million. Up net income profitability. Additionally, net interest income revenue, or NIM revenue, of $183 million exceeded lending non-interest net revenue of $144 million for the first time. And importantly, our NIM revenue is meaningfully greater than our directly attributable lending expense of $106 million. In Q4, we had an incremental GAAP net income margin of 42%, resulting in a loss of just $40 million, roughly half of the third quarter 2022 loss. Said another way, of the $171 million of incremental GAAP revenue year over year, $71 million, or 42%, dropped to the GAAP net income line. Given these accomplishments, in our 2023 plan, we expect to achieve quarterly positive GAAP net income in Q4 2023. Our strategy is continuing to play out with SoFi Money, which allowed us to surpass $7.3 billion in deposits, up 46% quarter over quarter, and savings of 190 basis points on cost of funds versus using other sources of debt to fund loans. Another quarter of positive GAAP net income for the SoFi Bank at over $30 million and at an 11% margin. Finally, we grew our tangible book value for the overall company for the 2nd consecutive quarter. Q4 also saw our 2nd highest quarter ever of member ads and our 3rd highest quarter of product ads, with strong momentum continuing into Q1. The 487,000 new members in Q4 2022 brings total members to 5.2 million, up 51% year over year. We also added nearly 700,000 new products in Q4, ending with nearly 7.9 million total products, up 53% year over year. Of these new adds, financial services products grew by 60% year over year to 6.6 million, while lending products were up 24% to over 1.3 million. The strength of our results once again underscores how our full suite of differentiated products and services provides a uniquely diversified business that has been not only able to endure, but to thrive through market cycles. Now I'd like to touch on segment level results with a particular focus on the benefits of our diversified business drivers, as well as the structural advantage of our bank charter. In lending, we generated a record of $315 million of adjusted net revenue, up 51% versus the prior year period. Our personal loan performance more than offset the continued lack of demand in student loan refinancing and the less robust performance of home loans. Student loan refi continues to be negatively impacted as federal borrowers again await clarity on the end of the moratorium of federal student loan payments. Home loans faces macro headwinds from high rates while we continue the process of transitioning to new fulfillment partners. The personal loans business maintained its strength in Q4. We originated nearly $2.5 billion, up 50% from $1.6 billion in Q4 2021. This product continues to deliver even as we've raised our coupons to our borrowers as a result of rate increases and maintained our stringent underwriting criteria. While these origination levels themselves for funding sources provide new options to fund lending growth while driving efficiency with cost savings. These advantages are a direct result of SoFi Bank. Having more flexibility with our balance sheet allows us to capture more NIM and optimize returns, a critical advantage in light of the macro uncertainty. Additionally, by using our deposits as a funding source, we benefit from a lower cost of funding for loans. In Q4, the difference in our deposit cost of funds and warehouse cost of funds was approximately 190 basis points, whereas 125 basis points in Q3 and just 100 basis points in Q2, a powerful benefit in a rising rate environment. Lastly, the bank contributes to strong growth in SoFi Money members, high-quality deposits, and improved levels of spending and engagement. This has led to higher average balances, even as average spend has increased. Of the $7.3 billion in deposits at quarter end, 88% were from direct deposit members. Roughly 50% of newly funded SoFi Money accounts are setting up direct deposit by day 30 versus 20% in Q4 21. And this has had a significant positive impact on spending. Q4 annualized spend was 3.4 times 2021 total spend, and Q4 spend per average funded account was up 25% quarter over quarter. SoFi Money members have increased nearly 53% year over year to 2.2 million in total. Given the quality of these members with 745 median FICO score, we see ample opportunity for cross-buy. This is a great segue into financial services more broadly, where net revenue nearly tripled year over year to $64 million and grew 32% from $49 million sequentially in Q3. Moreover, financial services annualized revenue is now approximately $260 million. Contribution loss of $44 million improved $9 million versus the third quarter, even as we invested $13 million more in marketing in the fourth quarter. We saw this as a worthwhile opportunity to attract more direct deposit members. Even with this spend, variable profit, including all marketing costs, improved quarter over quarter and was nearly break even. We still anticipate the financial services segment will be contribution profit positive in 2023 as we continue to scale and monetize the business. We finished Q4 with 6.6 million financial services products, up 60% year over year, and 4.9 times total lending products of 1.3 million. The increased scale of financial services helps drive cross-buy and marketing efficiencies over time. The scale of financial services not only drives cross-buy and marketing efficiencies, it also is proving to be a large revenue contributor as we continue to drive monetization of these businesses. In fact, Annualized revenue per product is up nearly 2x from $21 in Q4 of last year to $40 in this quarter. This is due to the increasing attractiveness of these products, growing brand awareness, and network effects. As we've committed, we continue to iterate and invest aggressively in our product suite, and that investment continues to pay dividends as members embrace our launches. Since our last earnings call, we introduced an increase in our checking and savings APY of up to 3.75% as of January 4th. We launched SoFi Plus, a premium member service that bundles together our wide variety of member benefits and provides incremental value and rewards. SoFi Plus is unlocked through enrolling in direct deposit. We will continue to add more value and benefits to this premium member service to not only highlight the breadth of our products and services, but to also increase the total value of having your direct deposit with SoFi. We expanded insurance coverage for our members to include cyber insurance. Our Invest team launched options trading, making good on our promise to our members to deliver this much anticipated service. And we introduced a new way to spend with SoFi with Pay in 4, their first product built on the combined Galileo and Texas's platform. This leads me to our technology platform segment, which remains a critical element of SoFi's strategy. In the fourth quarter, full segment revenue of $86 million grew 61% year over year, with a 20% margin at the segment level, or 24% if you exclude Technisys. The SoFi technology platform strategy includes growth in new verticals, new products, and new geographies. In Q4, Galileo signed 11 new clients and made big strides in the strategy, with 36% of new deals in B2B and 27% of new deals outside the United States. Importantly, of these 11 new deals, 9 have existing customer bases, reflecting the continued demand for our innovative services from more mature organizations. Technisys is also delivering strong growth in number of new clients, signing an additional 16 new clients in Q4, including its first digital deal in Mexico. I'll finish here by saying that we've been in an all-out sprint over the last 5 years to build out our digital product suite to meet our members' needs for every major financial decision in their lives and all the days in between. The benefits of our strategy, resulting in a uniquely diversified business, combined with a national bank license, not only positions SoFi to be the winner that takes most in the secular transition of the financial services to digital, but also to provide greater durability through a market cycle. I'm excited about where we are today, and even more excited about where we can go from here. With that, let me turn it over to Chris for a review of the financials for the quarter.
Thanks, Anthony, and good morning, everyone. We finished off a remarkable year while navigating a rapidly evolving macro backdrop, even as our previously largest and most profitable business operated at 25% of Q4 2019 pre-COVID volumes. This proves once again that our diversified and differentiated business model drives SoFi's durability and long-term growth potential. I'm going to walk you through some key financial highlights and then share some color on our outlook. Unless otherwise stated, I'll be referring to adjusted results for the fourth quarter and full year of 2022 versus fourth quarter and full year of 2021. Our GAAP consolidated income statement and all reconciliations can be found in today's earnings release and the subsequent 10-K filing, which will be made available in the coming weeks. For the quarter, top-line growth accelerated, and we delivered record-adjusted net revenue of $443 million, up 58% year over year, and 6% sequentially from the third quarter's record of $419 million, and above the high end of the guidance provided during our last earnings call. Adjusted EBITDA was $70 million at a 16% margin, also above the high end of our most recent guidance. We saw 14 points of year-over-year and 5 points of sequential margin improvement, demonstrating the strong operating leverage of the business as it scales. Year-over-year margin improvement has been driven by significant operating leverage across our sales and marketing, G&A, and ops functional expense lines. Overall, this resulted in a 40% incremental adjusted EBITDA margin year-over-year. Our GAAP net losses were $40 million this quarter, a $71 million improvement year-over-year, and $34 million improvement sequentially. Incremental GAAP net income margin was 42% year-over-year, a notable step in our path to GAAP profitability. In addition to our adjusted EBITDA margin expansion, we saw meaningful leverage against stock-based compensation as a percentage of revenue at 16% in Q4 2022, down from 27.5% in the same prior year period, putting us well on our path to longer-term goal of single-digit stock-based compensation margins as previously communicated. For the full year, we delivered $1.54 billion of adjusted net revenue, up 53% year-over-year from $1.01 billion in 2021. As a reminder, we revised our annual guidance in April of 2022 following the extension of the moratorium on federal student loan payments. Our updated guidance for the year included $1.47 billion in adjusted net revenue and $100 million in adjusted EBITDA. This guidance contemplated an ultimate extension in the moratorium until year-end, which implied a Q4 ramp in student loan refinancing activity ahead of the anticipated resumption of federal payments. From an adjusted EBITDA perspective, we delivered $143 million in profit, nearly 5 times that of 2021, and $63 million above the guidance we presented following the moratorium extension I just discussed. 2022 delivered a 9% adjusted EBITDA margin, 630 basis points of improvement from 2021. Even with the recent subsequent extension of the moratorium through June of 2023, which impeded the expected Q4 2022 ramp in student loan refi demand, we still exceeded that revenue guidance by $80 million and adjusted EBITDA by $43 million. We achieved these results by implementing new strategies and through nimble asset allocation, which speaks to our ability to leverage the diversity of our revenue streams. Now onto the segment level performance, where we saw strong growth across all 3 segments. In lending, fourth quarter adjusted net revenue grew 51% year-over-year to $315 million. Results were driven by 138% year-over-year growth in our net interest income, while non-interest income was relatively flat. Growth in net interest income was driven by a 109% year-over-year increase in average interest earning assets and a 317 basis point year-over-year increase in average yields, slightly offset by a 162 basis point increase in the cost of interest-bearing liabilities. This resulted in average net interest margin of 5.94% for the quarter, up 141 basis points year-over-year. Non-interest income was relatively flat year-over-year as increased personal loan originations at higher weighted average coupons were largely offset by lower student loan and home loan originations. Personal loan originations grew 50% year-over-year to $2.5 billion, while student loan originations were down 73% and home loan originations were down 84% year-over-year as a result of macro headwinds and a continued transition of home loan fulfillment partners. Overall, we achieved strong top-line growth while maintaining our stringent credit standards and disciplined focus on quality. Our personal loan borrowers' weighted average income is $165,000 with a weighted average FICO score of 747. Our student loan borrowers' weighted average income is $170,000 with a weighted average FICO of 773. This focus on quality has led to continued strong credit performance. In fact, our on-balance sheet delinquency rates and charge-off rates remain healthy and are still below pre-COVID levels. Our on-balance sheet 90-day personal loan delinquency rate was 34 basis points in Q4 22, while our annualized personal loan charge-off rate was 2.47%. Our on-balance sheet 90-day student loan delinquency rate was 13 basis points in Q4 2022, while our annualized student loan charge-off rate was 0.37%. As we have expressed in the past, it is reasonable to expect credit metrics to revert over time to more normalized pre-pandemic levels, but we continue to expect very healthy performance relative to broader industry benchmarks. The lending business delivered $209 million of contribution profit at a 66% margin, up from $105 million a year ago and a 51% margin. This improvement was driven by a mix shift to higher margin personal loans revenue, along with marketing and ops efficiencies, as well as fixed cost leverage across the entire segment. For the full year, lending adjusted net revenue grew 45% to $1.11 billion, and the segment delivered $664 million of contribution profit at a 60% margin. Shifting to our tech platform, where we delivered net revenue of $86 million in the quarter, up 61% year-over-year, or up 13% excluding Technisys. Overall, Annual revenue growth was driven by 31% year-over-year Galileo account growth to 131 million in total, as well as sequential growth in transactions per active account. We also signed 11 new clients, 4 of which are in the B2B space, and 3 of which are in Mexico, further diversifying our partner base. During the quarter, one of our clients migrated the majority of their processing volumes to a pure processor, which resulted in a $6 to $7 million revenue headwind in period. Segment contribution profit of $17 million represented a 20% margin and 24% if you were to exclude Technisys. For the full year, the tech platform segment grew revenue 62% to $315 million and delivered $76 million of contribution profit at a 24% margin. Excluding Technisys, revenue growth was 24% year-over-year and contribution margin was 30%. Moving on to financial services, where net revenue of $65 million increased 195% year-over-year, with new all-time high revenue for SoFi Money and continued strong contributions from SoFi Credit Card, SoFi Invest, and Lending as a Service. Overall monetization continues to improve, with annualized revenue per product increasing to $40, nearly 2 times the $21 in the same prior year quarter, and up 25% sequentially from $34. We reached 6.6 million financial services products, up 60% year-over-year, by adding 635,000 new products in the quarter. We now have 2.2 million products in SoFi Money, 2.2 million in SoFi Invest, and 1.9 million in Relay. Contribution losses were $44 million for the quarter, which improved sequentially as a result of the growth in revenue, as well as fixed cost leverage, but increased year-over-year predominantly as a result of building our CECL reserves for the SoFi Credit Card business, which is expected as we continue to grow and scale. In addition, we saw a year-over-year reduction in higher margin digital assets revenue. For the full year, the segment delivered $168 million of revenue, which is nearly 3 times the $58 million we delivered in 2021, and our contribution losses were $199 million. Notably, that's a 21% improvement in contribution loss per average product during 2022 versus 2021. Switching to our balance sheet, where we remain very well capitalized with ample cash, excess liquidity, and strong regulatory capital and leverage ratios. This year's opening of SoFi Bank further reinforces our strength and provides more flexibility and access to a lower cost of capital relative to alternative sources of funding. In Q4, assets grew by $3.2 billion as a result of the strong growth we continue to see in personal loan originations. On the liability side, we saw tremendous growth in deposits to $7.3 billion, up $2.3 billion quarter over quarter. Because of this, we exited the quarter with $3.1 billion drawn on our $8.4 billion of warehouse facilities, which represents 36% of our total available capacity. Our current book value is $5.5 billion, and our tangible book value has grown for 2 consecutive quarters, with more than a $50 million increase sequentially in Q4. Let me finish up with guidance. Before going through the specific numbers, I want to hit on some of the larger macro assumptions that underpin our financial guide. From an interest rate perspective, we are assuming an outlook consistent with the consensus forward curve, with a peak Fed funds rate reaching approximately 5% in Q2 2023, with 2 rate cuts in the back half of the year to get us to a 4.5% exit rate in 2023. We are assuming a 2.5% contraction in GDP and a normalization of unemployment to around 5%. And from a credit perspective, we are expecting a continuation of elevated credit spreads across capital markets and a continued normalization of consumer credit. For Q1, we expect to deliver adjusted net revenue of $430 to $440 million and adjusted EBITDA of $40 to $45 million. For the full year of 2023, we expect to deliver adjusted net revenue of $1.925 to $2.0 billion, representing 25 to 30% growth, and adjusted EBITDA of $260 to $280 million. Our outlook represents 30% incremental EBITDA margins for full year 2023 versus full year of 2022. And we expect to reach quarterly GAAP net income profitability by Q4 2023, with GAAP net income incremental margins for the full year of 20%. Finally, quickly hitting on a few key points for each segment. In our lending segment, we expect the Department of Education's moratorium on federal student loan payments to extend through June 30th, 2023, at which point there are 60 days before repayments actually begin. Accordingly, our outlook assumes that we will be operating at our current run rate levels until September. After September, we do believe there will be a recovery to higher levels of student loan refinancing revenue than the current trend, but we do not expect to return to pre-COVID levels in 2023. In our personal loans business, we expect to see modest growth as we balance taking advantage of ample headroom in this business, given our current market share and differentiated product, with a thoughtful and prudent approach to ensuring our credit remains very high quality. We remain committed to underwriting to an industry-leading life of loan loss profile. In our tech platform segment, one area of focus for us in 2023 is on quality of new clients, including size, durability, and time to market over quantity, which means bigger wins that leverage the combined go-to-market value proposition of the tech platform while still investing in focused new product areas to drive diversification. While we expect low double-digit organic revenue growth in 2023 due to this focus and a variety of other factors, our longer-term strategy is already starting to pay off with greater diversification in our pipeline and significant margin expansion expected in 2023. After a 3-year investment period in the tech platform, including moving to the cloud, a 2.5x increase in headcount, the acquisition of Technisys, and launching new product capabilities, we will increasingly focus on leveraging the value of our investments through the synergies between the two product lines, Technisys and Galileo, as well as through joint product offerings, all to drive meaningful contribution profit growth relative to revenue growth. In starting to operate as one unified technology platform, we have recognized opportunities to reduce our costs, including a small reduction in headcount. In financial services, we expect continued strong growth in revenue, driven by growth in products, as well as increased monetization per product as we scale deposits, spend, and AUM. Importantly, we will front-load investments in the year to take advantage of attractive opportunities to continue to scale our high-quality deposit base. In summary, we could not be more proud of the results SoFi delivered in 2022. We exceeded $1.5 billion in annual revenue and grew adjusted EBITDA nearly 5 times to more than $140 million. We continue to be extremely well capitalized and are excited about the opportunities in front of us. We look forward to another strong year in 2023. With that, let's open it up to questions.
Margin expansion, that's what it sounds
Thank
like.
you. Analysts will be allowed to ask one question each. Please re-enter the question queue for a second question. As a reminder, if you'd like to ask a question, please press star followed by 1 on your telephone keypad. If you would like to withdraw your question, you may press star 2. Please ensure you are muted locally when asking your question. So our first question comes from the line of Michael Ng of Goldman Sachs. Your line is now open. Please go ahead.
Hey, good morning. Thank you very much for the question. I appreciate all the color around 2023. I was just wondering if you could go into a little bit more detail around the origination assumptions. Give some detail around student loan and personal loans. Could you do that for home loans as well? Thank you very much.
Stupid question.
Yeah, sure. So I can hit that one. Nancy can chime in. So in terms of our overall outlook on originations, going back to what I said in my prepared remarks, we are assuming modest growth in our personal loans business. We do see there being ample headroom for continued growth, given where our market share is today. Currently, we're at about a 6% market share in our credit box. That's up from about 4.5% a year ago. So significant headroom ahead of us, but we are going to take a prudent approach to this and continue to monitor credit and make changes as necessary. In student loan refinancing, we're assuming that originations are at the current run rate levels at least through the end of August of 2023. And we do expect a bit of an uptick once the moratorium ends in June, followed by a 60-day extension. And then in home loan originations, we expect to continue at the current pace that we're at right now with a potential uptick in the back half of the year as we resolve all of our fulfillment issues.
Our next question comes from the line of Dominic Gabriel of Oppenheimer. Please go ahead.
Hey guys, great results. So I just wanted to talk about the deposit growth. I mean, it's really been, Anthony, it's been really, astounding how much deposit growth you've gotten over the last year. And I'm just curious about how you think about, an environment where you may need less deposits, and how you would go about perhaps trimming that growth rate in that environment. If, like, let's say originations are down, is it rate or is it, something else? Any color you can provide on that outlook would be excellent. Thank you so much.
Yeah, thank you, Dominic. We're really pleased and proud of what we've been able to achieve on the deposit side, getting to over $7 billion of deposits, starting at less than $1 billion at the beginning of the year. And that trend really reflects the strategy that we've employed behind the bank to offer a very high interest rate on checking of over 2% and a high interest rate on savings at 3.75%. No fees and complete functionality on your phone to be able to pay bills, to be able to send money to your friends, to be able to look at all of your transactions, to be able to really function all of your money movement right from our app. The combination of that plus the focus we've had on driving high quality direct deposits has driven that deposit number. What I'd say is we're nowhere close to the point in our total deposits that we would have trouble deploying them. The limit on our growth is really driven by how much resources that we have to go after it. Once people become aware of our product, the adoption is pretty strong behind that. And so the deposits that we have today could be deployed the way we have the last several quarters, one, to fund our own loans, two, to be opportunistic on opportunities related to our loans that are in the marketplace. There are several businesses we're not in today that would leverage deposits, including small, medium business loans. And being in that entire sector would require deposits as well. And we could leverage, obviously, growing deposits from small, medium businesses also. So if we get to the point that our deposits are significantly higher than they are today, we can deploy them in many, many other ways to drive a great return for the company.
Our next question comes from the line of Kevin Barker of Piper Sandler. Your line is now open. Please go ahead.
Piper Sandler.
Good morning. Thanks for taking my questions. Your balance sheet's grown tremendously over the last year, partly due to the deposit growth. Could you talk about, there were differences between a held for investment versus a held for sale strategy? In particular, we've seen several companies start to come back to the securitization market in the first quarter with spreads tightening relative to late 22 numbers. I'm just trying to see, how you balance, driving net interest income versus potentially some fee or gain on sale income, and how you think about that for the rest of the year. Thank you.
Yeah, thank you for the question. We noted in the press release and prepared remarks that we hit a couple of key inflection points in the year. One of the biggest inflection points is that our NIM, our lending net interest margin revenue, is now greater than our non-interest revenue. And that's a pretty big milestone. It reflects a lot of initiatives over the last 5 years, one of which was getting the bank license and being able to use deposits to fund our loans and not have to recycle that cash through quick sales, et cetera. So we have the luxury of being able to look in the marketplace, look at our balance sheet, and make the best decisions for long-term returns. And as we've done that, we've been able to hold loans longer and generate that revenue stream that's more recurring from that interest margin. You should expect the NIM to continue to grow, both in absolute dollars and as a percentage of total revenue in the lending sector. The second big accomplishment was that for the full year, we were able to, in the fourth quarter, we were able to get the NIM revenue greater than the directly attributable fixed cost of the lending business, meaning the non-interest income lending revenue wasn't needed to get to profitability at the contribution basis in Q4, which is another big milestone. But you should expect that to continue to grow. It is a revenue stream that's more visible and more consistent than gain on sale non-interest income. But we have the luxury of making the best choices based on the marketplace. I'll let Chris talk about the specifics in terms of securitizations versus whole loan sales versus holding.
Yeah, in terms of the ABS market, we're seeing the exact same trends that you highlighted in your question. Back in November, we actually did a $600 million term securitization deal at an attractive cost relative to where we expect warehouse cost of funding to be in 2023. And things have continued to improve in the overall market, in the first month of this year. So we expect to be able to access that market here in Q1 and for the rest of the year.
Our next question comes from the line of Moshe Orenbuch of Credit Suisse. Your line is now open. Please go ahead.
So maybe as a follow-up to that, can you talk about what you actually sold during the quarter in personal and student, and did you actually buy any portfolios during the period as well?
Yes, I can hit on that. So in terms of sales for the quarter, we ended up relying predominantly on deposit funding, warehouse funding, and that term securitization. We did about $200 million worth of whole loan sales and a $600 million term securitization, so about $800 million in total. In terms of loan purchases, like I said during the last quarter, having the bank with a large and growing deposit base provides us with much more flexibility and a new source of funding our loans, which allows us to grow the balance sheet and hold loans for a longer period of time. There are a few ways that we can bring loans onto the balance sheet. We can go out and pay an upfront marketing cost and originate them, or we can purchase the loans. So similar to Q3, we had the opportunity to buy some seasoned loans. This time they were in the student loan refinancing space, and these were all loans that we originally underwrote. Overall size was about half of what we did in Q3. And given the credit quality, loss profile, and return characteristics, we jumped on the opportunity as we knew the borrower best, and it will set us up for really strong net interest income in the coming quarters, given our overall cost of funding. And then we also had a few $100 million of normal course cleanup calls on some of our consolidated securitizations that were several years seasoned.
Our next question comes from the line of Eugene Simonsai of Towers. Your line is now open. Please go ahead.
Who?
Sorry, is Eugene Simoni from MoffettNathanson. Hi, guys. How are you? Quick question from me back to the outlook for 2023. Very helpful to have the color, Chris. But I was wondering on the swing factors, let's say the factors that would allow you to go to the high end of your range guide, what would be the top 2 or 3 things that you guys are looking for, that could swing the results here in 2023?
Hey there, Eugene. Thank you for the question. Chris laid out in our prepared remarks some of the underlying assumptions, both macro and micro. On the macro side, GDP growth that's not as dour as we have in our forecast and our implications, so a stronger economy than what we have. And we think a relatively conservative, i.e. low number for GDP, a decline of about 2.5%. Unemployment we had at 5%. That's a factor. If it comes in, worse than that, that could be a negative. A tailwind would be if it settles in the 4s. And then on interest rates, we have them peaking at 5% and then coming back down to about 4.5%. If rates came back even more than 4.5% and settled in the 4% range, I think we could be at an optimal part of the curve as it relates to passing on coupons, profitability per loan, as well as the NIM that we can make relative to our deposits. Would be a pretty good outcome. Separate from that, for the technology platform sector, we have a really robust pipeline. It's more diverse, but more importantly, there are many clients in our pipeline that have large existing consumer bases or user bases. And to the extent that those become launched in 2023 before the second half of the year, we can benefit from upside in those large partners coming on board from the tech sector. As it relates to the financial services sector, I really believe we have a lot of upside in the invest category. We are quickly launching new products to make sure that we have some table stakes products, but also some more innovative differentiation on selection. And I think that if we're able to launch those to a receptive member base and user base, it could be a tailwind. Second thing that could be a tailwind to invest is if the IPO market opens back up. We can underwrite IPOs. We're the sole retail distribution channel for the Rivian IPO. We've participated in the Nubank IPO. Our members want access to IPOs at IPO prices. We're uniquely providing Main Street with access to IPO prices at those IPOs at IPO prices. To the extent the calendar opens back up, we have a pipeline there as well, which helps both with adoption of the product by new users, because they want that unique selection, but it also drives incremental assets under management, which allows us to drive more revenue and monetize more. So those are some of the underlying trends that could give us a tailwind when we pass over to Chris.
Yeah, the only other thing I would add to that, Anthony, is back to one of the comments that I made a few minutes ago around credit spreads. So implied in our guidance and what I mentioned is that we're expecting to see continued elevated credit spreads throughout the year. Obviously, things are looking pretty good in January, and spreads have tightened, and the ABS market seems to be showing some signs of life. So if that continues throughout the year, there could be additional upside in the lending business as well.
Our next question comes from the line of Mahir Bhatia of Bank of America Merrill Lynch. Your line is now open. Please go ahead.
Good morning, and thank you for taking my questions. I just wanted to ask about the technology platform segment. Sounds like a little bit of maybe not change, but refinement in the strategy as you go after, you're focusing on quality of clients and bigger clients with existing bases. What are some of the implications of that strategy? And I was also curious in terms of just new product introductions or cross-sell to existing clients in that segment. Like, as we think about, your growth from here, how much of it is going to come from, cross-sell, cross-buy, if you will, in that segment versus winning some of these new large partners? Thank you.
And thank you for the question. And I think you characterize it appropriate in that it's a refinement of the strategy. Now that we're operating on one unified platform with both Technisys and Galileo, we can leverage the combined go-to-market, and that does drive some synergy cost savings, which is why Chris mentioned, small headcount reduction. But there are also cost savings in different areas, like marketing, when you have that unified approach, especially in the United States. In addition to that, we've made really significant investments in the tech platform over the last 3 years. We've increased headcount by 2.5x. We moved to the cloud while maintaining on-prem capabilities. The on-prem will now go away this year. We've also done a great job at adding new partners. We've been adding 20 plus partners a year. As we look at the macroeconomic environment and where we sit, we think the right strategy for the year is to focus on durable companies with large installed bases, or well-capitalized companies that we know can make the transition and that will get a great return to leverage our platform capabilities. And so that's how we're approaching the year. For the first time, we're going to have meaningful margin expansion in the tech platform to start to leverage that investment we made. But we're still investing, we're still growing. And let me give you an example of some of the areas that we've invested in that we expect to bear fruit this year and that we'll keep investing in. First and foremost, we want to diversify our products just out of a debit or interchange ACH type of product, expanded in the B2B category. We have a number of new B2B partners that are generating revenue today. Some are doing small, medium business lending. Some are simply using it for payments and for accounts receivable and accounts payable. But there's a good pipeline of other partners that have large fleets, as well as gig economy companies, et cetera. In addition to building out the B2B channel, we've also tried to add more products for consumer-facing clients. And so one of the products that we have that's been adopted is Secure Card. Another product that we've launched more recently is a fraud protection. As you think about fraud and you think about the scale of some of the partners of Galileo, they may not have the scale to invest in fraud the way that we can, and they may not have the data that we have to actually drive those models. And so we've rolled out one piece of a fraud platform that we want to make available to all of our partners. If we can help them eliminate fraud, it not only saves losses, but it actually makes their service more reliable, reduces the overhead they have in call centers, and it also allows them to hit better SLAs in servicing their customers when they do have issues that have to be solved. So it's a classic make your footprint bigger than your foot type of product. In addition to that, we're focused on things that will help them drive engagement. So we've launched a direct deposit switching product, and you'll see us continue to do more there to drive more engagement. Things like instant funding are another vehicle that makes the movement of money faster and better for our partners. And then last, we just launched our first product on both Galileo and Technisys and SoFi, which is Pay in 4. That product is now available for any of our partners. And if you think about the partners at Galileo, many of them are not playing the same segment that we are. We're at a very high-end customer with high FICO score and high income. Most of the scale in Galileo's partners is actually at the unbanked or underbanked. A Pay in 4 product is much better for them than a secure card or an unsecured loan or a credit card. And that product can be launched in a turnkey fashion with a much higher interchange of about 3% compared to what they're generating at 1% in debit. It does bring with it some risk, and so we'll have to wade cautiously into that market with our partners. But it's another example of the innovation that we've driven that we now think we can get a return on revenue against. And the last thing I'll touch on is Connecta. It's not something we've talked about on the call before, but we think it's a diamond in the rough, so to speak. It's an AI-driven customer service model that uses both voice and text. And that product is one that SoFi has now adopted. And that's after SoFi did a complete RFP of all the different choices and determined Connecta to be the best choice for our company. And we'll continue to invest in that product. It's available to our partners as well. And the last thing what I'd say about our strategy related to the technology platform is that the opportunity to expand geographically is bigger than you could imagine. We have to really pace our level of investment. And while we're not expanding geographically today, there's a lot of penetration within the LATAM market, which is our area of focus, especially with Technisys in more than 12 markets, helping cross-sell Galileo's products.
Our next question comes from the line of Dan Dalby of Mizuho. Your line is now open. Please go ahead.
Hey guys, great results. Thanks for squeezing me in. Can you maybe give us some, quarterly trends on sort of particularly the three metrics, student loans, personal loans, and mortgages? Just kind of how things are trending through, say, the end of January. Thank you.
Yeah, so thanks, Dan, for the question. So we aren't providing specific views on how things are trending right now, but what I would say is on the student loan front through January, as mentioned in our guide, we expect it, to be at the existing run rate levels that we saw in Q3 and Q4. In personal loans, things are progressing as one would expect. There's a lot of headroom in that business, but we're being mindful with respect to credit. And then in the home loan side, we have made some really good progress over the course of the last 2 to 3 months in terms of some of those fulfillment issues that we've talked about previously. And things are trending in the right direction. Anthony, I don't know if there's anything you'd add there.
Yeah, the only other thing I'd add, Dan, is I did say in my prepared remarks that we're seeing the strong trend in member and product growth continue into Q1. We've, throughout the year, are constantly iterating on marketing channels, on marketing messages, on lifecycle marketing and leveraging the most efficient channels. And I feel like in the fourth quarter, it was a culmination of a lot of work over the last 2 years. And we saw the benefit of that. And as we started the new year, we continue to see that. So we feel really great about not just the growth rate in members as well as products, but the quality of those members and product adoption in addition to the cost of acquisition.
Our next question comes from the line of Ashwin Shirvaikar of Citigroup. Your line is now open. Please go ahead.
Thank you. Congratulations on the results. Questions on the process of transfer to new fulfillment partners. And you just mentioned that the last 2-3 months have been good, Chris, but what should investors expect in terms of timeline, financial impact? It's been a few quarters this has come up, and what's the main factors that seem to be, affecting a more timely transition?
Yeah, and just to give you a little bit of history here, we had a partner that was helping us drive great success on the back end fulfillment side of the equation. We do the marketing to drive the demand at the top of the funnel. We do the underwriting for the loans, and after that loan is locked, we partner with a fulfillment partner to get through all the steps after that. That partner unfortunately got acquired. We were then required to make a technology platform switch with the new acquired company, which was costly and time consuming. And ultimately the economics that that entity was seeing became quite onerous as rates increased. And we realized that the economic relationship that we had was changing. We needed another partner. We started pursuing other partners, quite frankly, well before that acquisition happened, just needing diversification. And so we fast-tracked the second partner that we needed to transition to. That transition didn't happen as quickly as we would hoped. I will tell you in the last 2 months, we've seen more progress there than we have in the last 18 months. And I'm encouraged by the progress the team has made, both in terms of the technology integration, the process flow, the ability to hit time to funding metrics and serve our members better. We're nowhere near perfect, but we're starting to move in the right direction for the first time in a while. In terms of the economic impact on the overall business, Chris was pretty clear in saying that it will ramp throughout the year. I would think about it as more second half of the year than the first half of the year. But the team is executing in a way that I think positions us really strongly to start stepping on the gas a little bit more as it relates to demand. We've had our foot off the gas, quite frankly, because we don't want to generate demand that we can't fulfill in a high quality way. And we're starting to get to the point, I think we'll be there by the second half of the year where we could step on the gas and start to see a much bigger market share gain there. We have such small market share, even with higher interest rates. I think there's a huge opportunity for us to drive revenue there, as well as that revenue being profitable. In addition to that, we do at some point, similar to the rest of our businesses, want to own it end to end. We own lending from metal to glass, so to speak, and it gives us such advantages on iterating, on testing, on pricing, on credit, on user flow, on fraud, on risk. And we see the same thing now in SoFi Money, owning Galileo and having the benefit of Technisys as well. And so at some point in home loans, we'll own the back end also. We will always partner. It's great to have two sources of capacity, especially given our aspirations and how big we think this could be. It is a huge financial transaction for our members. It is an emotional transaction, and we need to be able to scale it and meet the needs of all of our members, and that's where we're focused on long term.
Our next question comes from the line of John Hecht of Jefferies. Your line is now open. Please go ahead.
Hey guys, thanks for taking our questions and congratulations on the quarter. Anthony, you talked about B2B customers signing up, and you guys have had good, really good momentum out of numbers. But I'm just wondering, can you characterize the recent inflows of customers and members, any change in terms of marketing and customer acquisition activities from prior quarters, and how do you think about any changes and opportunities in 2023?
Hey, John, it was really hard to hear your question. I don't want to guess what your question was. Maybe you could dial back in with a better connection. I heard something about B2B, and then it was pretty muted after that.
Is this better? Sorry, guys. Is this better?
Yeah, perfect. Thank you.
I'm sorry. Can you hear me now?
Yeah, we can hear you.
Okay, I apologize, guys. My headphones are bad. The question was just, Anthony, you mentioned B2B activity. You guys clearly still have very positive momentum with new members and new customers. I'm wondering, as given your channels of customer acquisition, the cost of customer acquisition, has there anything changed from a characteristic perspective, and how do you look at opportunities from that regard in 2023?
Yeah, so the SMB opportunity, I think, is really a opportunity that's aligned with the type of member that we're acquiring in our core target. We don't have plans in 2023 to enter that market. We do believe it's an opportunity for us over the longer term to serve that market well. If you follow, us on any social media, it's a constant request that we get from people to launch small, medium business checking and savings, small, medium business lending. When the pandemic first started back in 2020, March time period, we were inundated with tons of small, medium businesses coming onto SoFi and trying to apply for PPP loans. We clearly don't have small, medium lending. Now that we have a banking license, that is an area that we could go into, but we didn't at that point in time. We stood up a website that allowed us to take the traffic that came to SoFi and leverage Lantern to send the traffic to a marketplace of small, medium business lenders. And it was people were very happy with it. The demand as a result of that, led us to realize that many of our members are operating small, medium businesses, and that we could serve them on the commercial side as well. But as I mentioned, it's not something that we do in 2023. I would never say, that would stay the same. We'll review it every quarter. If the student loan market came back sooner than expected and some of the other things went our way in the economy and so forth, it may be something that we could focus on in the second half of the year. But right now, it's not on the funding list, but it's a huge opportunity for us. The only reason I mentioned it earlier was we'd been asked the question earlier about deposits and what happens if they grow too big. And that would be a great problem to have. If they grow in excess of what we're willing to originate on the personal loan side and SLR side and home loan side and credit cards, we would offer more lending products to make sure we're capturing that great resource of deposits to deploy against high returning assets.
Our last question today comes from the line of Michael Perito of Stifel. Your line is now open. Please go ahead.
Hey, good morning. Thanks for taking my question. Obviously, you guys have hit on a lot already this morning. I thought maybe I'd just ask Chris, can you maybe give us a reminder, some context around how you guys are thinking of capital of the bank in your 2023 projections? Obviously very healthy still today, but imagine, in the guide there's a bit of balance sheet growth baked in as you guys done in 2022, and just curious where you kind of have the capital ratios levering to and how that compares to kind of where you want to run the bank normalized going forward.
Yeah, thanks, Mike, for the question. So I'm not going to be providing guidance on the balance sheet size within the bank, but I'll at least provide a little bit of insight in how we're thinking about it. So right now, we've capitalized the bank with about $1 billion of capital. You'll see that in the bank call report that comes out later today. We're currently operating at about a 15% leverage ratio, which is still significantly above our regulatory limits. So we do expect to see additional balance sheet growth as we continue to scale our lending business. We expect modest growth in our personal loans business and then relatively muted in the student loan refinancing and some growth in home loans. The only other thing I would add in terms of being able to grow the bank balance sheet is that we are sufficiently capitalized at the parent as well. We're coming off of a year in 2021 of raising over $3.5 billion of capital, and we've only deployed $1 billion of that to the bank. So we have sufficient excess liquidity that we could capitalize the bank and grow it further if we wanted to.
And the only thing I would add on to that is something we were talking about as a team yesterday that doesn't get a lot of attention. But when you look at the asset side of our balance sheet, you look at the trend, and you look at our cash and cash equivalents, we finished the year at $1.4 billion of cash and cash equivalents. What's not in that number is $424 million of restricted cash. And then there's some investment securities, which is a combination of treasuries and government securities, as well as loans.
Get these bozos off the phone asking questions.
The trend in that line has been continuing to increase, which is speaks not only to the liquidity that we have, but the equity that we have that we can deploy either against funding.
None of them giving $10 price targets. So,
and it's one of the important measures that will continue to give you somewhat of a level of confidence on being able to fund the bank to grow more if we need to put more equity there.
Wrap it up. That's it.
Great. Thank you for dialing in today. I wanted to end with a couple of comments. February marks my 5-year anniversary at SoFi. And it's just very humbling what we've achieved during such an unprecedented time period, growing from less than $500 million in revenue to $1.5 billion at the end of 2022, 600,000 members to 5.2 million members, and negative adjusted EBITDA to $140 million of EBITDA, plus raising $3.6 billion in capital, becoming a public company, and receiving a federal bank license. But to have done all of that through 2 interest rate cycles, a recession with the potential for another, a global pandemic, inflation at a 40-year high, and in an incredibly competitive environment with significant access to near zero cost of capital is a remarkable 5-year run. None of this, though, happens without the full faith of our board and our shareholders, the persistent and unrelenting resolve of our people, and a team that has done nothing short of the extraordinary. Many can prognosticate about what lies ahead for the economy, interest rates, but in my view, the political background, the regulatory background remain very uncertain. and those exogenous factors are out of our control. But as it relates to what lies ahead, I will simply state my strongest belief that SoFi continues to be the best positioned company to be the winner that takes most in the digital financial services sector of the future. Reaching that outcome is what we control and what we remain steadfastly focused on to achieve. With that, thank you for calling in and listening to our fourth quarter results as well as our 2022 full year results. We'll talk to you next quarter. Thank you.
Goodbye, ladies and gentlemen. Today's call. Have a great day ahead.
Hey guys, one of the funny questions, I forgot who asked it. Some guy was like, do you plan on slowing down your deposits? And like tried to like scare Noto about like that it's bad to have deposits. And Noto was like, no, we're just gonna lend more when we get more deposits. I mean, come on, guys. Like, that was funny. Who the heck asked that question? I mean, so the guidance, remember this, this is what everybody needs to understand about SoFi that I've noticed over the past 2 years. They under-promise and over-deliver, okay? So everyone's saying, oh, SoFi said they will be profitable by Q4. You heard that from their mouths, okay? That doesn't mean they're planning to be profitable in Q4. That doesn't mean that. Look at the trend. It was 12 cents, 9 cents, 5 cents, okay? Okay, that doesn't mean they're going to be profitable in Q4. They could be profitable much faster. I mean, it could be Q2 or Q3. Think about it. If they do exactly what they just did, another $25 million cost savings, reducing, marketing, they're at 1 cent loss. Okay, that's Q1, 1 cent loss. If they improve just a little bit, boom, profitable Q2. So understand, a lot of people already calling me out about this Q4 stuff. They're telling you that because they know they're going to be profitable in Q4. But I'm telling you, if they just keep this trend up, think about it. 1 to 2 cent loss this quarter, Q1. Maybe some rate hikes. Maybe they can get their Galileo picking back up because, those fintechs start exploding again. Student loans. I mean, guys, I say Q2, Q3. Okay. So understand the trend. Go on my Twitter. The EPS trend is there for you to look at. It goes 12, 9, 5. That's 3, 4. You do what you just did again, 3 or 4. Like I said, you're at a 1 or 2 cent loss in Q1. They're just saying they're going to be profitable in Q4 because they're going to be profitable in Q4 once again, okay? So let's see. Deposits grew 2.5 billion. If we keep this same trend up for this year, that's 10 billion, 12 billion, 14 billion, 16 billion. Guys, we're looking at deposits 16 to 18 billion this year. 16 to 18 billion in deposits this year. That's going to get their lending business on fire. Member growth, we're at 5.2. Let's just keep up the 400K. We're at 5.6, 6 million, 6.4, 6.8. Okay, we're at about 7 million members this year. So 18 billion deposits, 7 million members, profitable fintech, student loans aren't there. If the student loans come back, they're saying 30% growth. That's going to go to 45. They're probably already underestimating 30%. They're probably at like 35%. So we could be seeing, 50% growth, not this year, but, next year when student loans come back up, and you're going to be talking about massive profitability with that. I mean, guys, everything is, lining in the horizon. You're getting everything you want. I mean, this market is just, you got Jerome Powell. This guy won't shut up. I mean, he just won't stop hiking up rates and stuff. So until it gets less volatile, you know, you know what I mean? I don't know. I don't know. The earnings are growing ridiculously, so we will be profitable this quarter. We would have been profitable 12 months ago. I mean, guys, student loans, that's a real business. It's not illegal. There's nothing wrong with it. You know, you should pay, for what you get. Okay. Options trading like Robinhood. That's another business. It's legal. I mean, why should they get options trading and we can't have student loans? What's the difference? Okay. It's a business. Okay. Everything in life, can't be free. Some people believe that. And that's why you got 3.5 years of extensions. Okay. So that's a business that will be coming back eventually. And oh yeah, and there you go. Goodbye, Affirm. Hello, Galileo. I mean, think about, okay. Before we wrap this up, this is what I want to do real quick. Okay, check this out. Okay, before we wrap this video up, all right. I'm gonna grab a couple fintechs. Okay, try and answer this as quick as you can. Okay, try and answer this as fast as possible. Okay, what is Affirm known for? We'll give you a few seconds. Buy now, pay later. What is Robinhood known for? Options trading. What is Lending Club known for? Personal loans. What is Coinbase known for? Bitcoin activity. What is SoFi known for? Bitcoin, personal loans, options trading, buy now, pay later. It has everything. So, depending on where the market environment goes, they just keep saying, we'll just pivot. We'll just do whatever works, whatever high rate environment, low rate environment. Bitcoin, personal loans, options trading. That's the difference from SoFi. It can withstand any environment. Okay. If you think this is an ugly environment, give them an amazing environment where, it just goes back and forth. It doesn't matter. Okay. Look at the EPS. This is supposed to be the worst environment ever. Morgan Stanley, was it Morgan Stanley or Goldman Sachs? One of them just put up the worst earnings profit in 10 years. They profited like $1 billion. They've been around for 200 years. They just had the worst profit in 10 years. And SoFi just grew their earnings, like much faster. So they're declining off of a cliff, and SoFi is getting there. Like it's the complete opposite. And this is supposedly, you hear Jamie Dimon, this is a terrible, terrible environment. Things are breaking down. We're seeing, and then SoFi is just like, our credit scores are 750. Our loans, the deposits are growing. Like it's just all BS because these legacy banks, they're still sitting on 10, 20, 30,000 of brick and mortar buildings that are just burning them up cash, and their customers are not happy as well. So it's just a couple more years. I think they're really going to start breaking down, and you're going to see some of these big legacy banks go into like the couple $100 million in profits, no more of these billion-dollar profits. I mean, they're just breaking down. So like I said, they have everything that Affirm, Robinhood, Lending Club, and Coinbase have in one. Okay, they feed off of any environment. So I'm out. Good earnings. Powell speaking. The market's down right now. We'll see how this goes. So hope everybody has a great day, and catch you later.